Hey friends, you want to know the secret to build a portfolio that pays you to live the dream life? Well, in today's video, I'm spilling the beans, the details on my current portfolio, stocks that are pumping out passive income like clockwork. So stick around. For the next 15 minutes, I'm going to break down my picks. I'm going to share my strategy. I'm going to reveal how to start cashing in on dividends. No matter what size your portfolio, you can do this too.
Welcome to 15 Minute Money, the show where I search the financial world for the most up-to-date investment ideas, market trends, and income streams so you don't have to. I'm your host, Nick Bradley. Let's get into it.
Before we jump into my dividend portfolio, let's talk about, what is a dividend? How is a dividend investment different from a regular stock? Regular stocks represent ownership in a company. Their value is based primarily on the performance of the future growth potential of that company. Investors profit primarily through capital appreciation, which is selling the stock at a higher price than they bought it for. And then dividend stocks, however, also represent ownership in a company, but in addition to the capital appreciation, they offer regular streams of income, therefore the dividend section. Companies choose to pay dividends from their profits, signaling financial stability and providing investors with predictable income source. So the amount of the dividend can vary, and companies you choose can increase or decrease the dividend. That can be tricky. If you get a company that decreases their dividend, your stock position, your appreciation could go way down. So you got to be careful what stocks you choose. But dividend stocks can be more appealing to investors, especially people like me seeking income, because I need income to live on. And the most important things in my portfolio are capital preservation and dividend yield. Growth is welcome, but it's more like priority number 3, not 1 or 2. Some people would argue that I should just invest in high growth stocks and sell off 4% of my portfolio to live off each year, but it's not the plan that I started when I did this a year ago. So I'm sticking to dividends and I'm sticking to options investing. So what am I holding in my dividend portfolio right now? Well, I have 9 positions totaling $163,000. So let's look at the portfolio overview. My total portfolio value is $15,000 in a company called ADX, $25,000 in a company called ARCC. I have $8,000 in a Bitcoin ETF. I have $5,000 in a MicroStrategies ETF. I have $10,000 in a stock ETF called QQQI. I have $25,000 in SCHD, $15,000 in SPYI, $35,000, which is too much, we'll talk about in a second, into TLT, a bond ETF, $25,000 in a REIT called Vici, VICI, and that totals $163,000. Now, let's take a closer look at the individual 9 holdings. Starting with number 1, Adams Diversified Equity Fund. It's 9.2% of my portfolio. Again, it's a $15,000 position. It's a diversified closed-end fund investing in large cap equities, primarily in technology, financials, healthcare, and consumer discretionary. It's managed a distribution policy at least 8% NAV annually, which is net asset value. It's paid quarterly, and the price of the shares is about $21. I have $15,000 divided by 21 or so. You're looking at about $692 or 692 shares. The dividend income yield is about 10.9% annually, giving you about $250 of annual income per share. So you take the 692 shares that I have, divide it by $2.50, and that equals $1,730.50 in annual income. The top holdings of ADX are Apple, Microsoft, Nvidia, and Amazon. That makes up 41% of the position, so it is pretty centrally, it's pretty tight on those technology stocks. Number 2, Ares Capital. Ares Capital, ticker symbol ARCC. It's a $25,000 position, about 15.34% of my portfolio. It's a business development company investing in middle market debt equity. Primarily is working in financials, healthcare, and technology. It has high dividends because business development companies, also known as BDCs, require at least 90% of its income to be distributed, and that's why they get good tax favor in the American government's eyes. Its price is about $21 per share. I have $25,000, so you take $25,000 divided by 21, give me about 1,190 shares. The dividend yield and income is 9.1%, which is $192 annual dividend, and it's very consistent with recent history. The annual dividend income is going to be my shares, 1,190 times $1.92, giving me an annual position of $2,285 per share. Number 3, ProShares Bitcoin ETF strategy, BITO, also known as BITO. I have $8,000 in BITO, which is 4.19% of my portfolio. It's an ETF tracking Bitcoin futures. It doesn't directly have Bitcoin. It's using the futures market to generate income. It pays monthly dividends, which is nice, from futures and swap income, and it's highly volatile. Again, its price is about $20. I have $8,000 divided by 20. I've got 400 shares exactly. Income is, are you listening? 50 or so percent. So using those, and that I say or so because it goes up and down depending on Bitcoin. The annual dividend per share is about $11.20. So the annual dividend income is 400 divided by the 1120. You have $4,480 of annual income I should receive this year from BITO. Number 4, almost halfway through. YieldMax MSTR Option Strategy ETF, ticker symbol MSTY. I call it Misty. I only have $5,000 in Misty because it's wild. If you know anything about MSTR, it's a stock that used to be a software company. Now they are a Bitcoin holding strategy. In fact, they've changed their name to just Strategy. Anyway, the $5,000 represents about 3% of my total portfolio. It is actively managed ETF using options on the stock MSTR. They generate monthly income, which is nice, but it has a very high volatile yield. And I'm actually down in this position, even though I'm making monthly income. The price per share itself has gone down, but MSTR has gone up a lot. So there is some sort of correlation where it doesn't track MSTR perfectly. Again, everything is going to be linked to Bitcoin in this. The price is about $25. 5,000 bucks divided by 25. I have 200 shares. The dividend income yield, are you ready? 143%. Now, that is the reported income. We'll see what actually happens. For this example, I'm using 20%, but this could really change a lot if it goes up a lot in the future. So, using the more conservative number of 20%, it's going to be an annual dividend per share of $5, assuming it's stable. So the annual dividend income, you get 200 shares times $5. I should get $1,000 a year from this $5,000 position. Number 5, NEOS. It's a NASDAQ 100 high income ETF, ticker symbol QQQI. I have 10,000 bucks in this. It's a pretty new position for me, and it is 6% of my portfolio. It tracks the NASDAQ 100 with a call writing strategy. This is something that I do on my own. So I didn't want to kind of get too involved in this because I am doing this strategy outside of the ETF. But basically they buy shares of a company, then they write covered calls against that, specifically the NASDAQ 100. And then as the NASDAQ goes up, they're making weekly income. So it's very tech heavy, right? The NASDAQ is tech heavy. You're going to have a lot of Apple. You're going to have a lot of NVIDIA. The price per share is about $50 when I got into it. At $10,000 position divided by the $50 it is, I have 200 shares of QQQI. The dividend yield, because of the option strategy, is 13.92%. So again, you got my 50 bucks per share times 13.92% should give an annual payment of $6.96 per share. On my 200 shares, that should give me an annual income of $1,392. Number 6, Schwab US Dividend Equity, also known as SCHD. I got 25 grand in that, about 15% of my portfolio. It tracks the Dow Jones US Dividend 100 Index, which holds actually 103 stocks, and it is very consistent, and it's had some high growth dividend companies. Coca-Cola, Home Depot. Price per share is around 25 bucks. I've got $25,000 into it, divided by 25. I got 1,000 shares, right on the money. The dividend yield compared to Misty is teeny, but it's 3.77. So $25 per share times 3.77 is $94.25 per share. Times that by my 1,000 shares, and I should receive $942.50 this year from SCHD. Number 7 on the list is NEOS, S&P 500 High Income ETF. I got 15 grand in NEOS, 9.2% of my portfolio. It tracks the S&P 500 with a call writing strategy for monthly income, which I like. It's diversified across sectors, but again, it is the S&P. So you're talking about Apple, you're talking about Coke, you're talking about Bank of America, you're talking about Nvidia, you're talking about Meta. Its price and share are about $50 or so. This is the S&P 500 after all. You got $15,000 in it at $50 per share, giving me 300 shares. The dividend income yield, pretty close to the QQQI. It's 12.11%. So again, $50 per share times 12.11% is $6.06 per share. I have 300 shares, so therefore I should have $1,818 in annual income from this position. 2 to go. And to the most boring of them, or should it be, the iShares 20-year Treasury Bond ETF, also known as TLT. I've got $35,000 into TLT, even though I don't want that much. I was writing cash secured puts against TLT earlier in the year. I got assigned quite a bit. And so now I have 21% of my portfolio in TLT. It tracks the long-term U.S. Treasury bonds. So you're looking basically at the 20-year Treasury. Its share price is about $95. I have $35,000 worth of it, around 95. I'm actually under, so I'm probably about 97. But let's stick with this math. About 360 shares. Dividend yield of about 4%, but I'm hoping that goes up in the near future. So about $95 per share at 4%, looking at $380 per share times the 368 that I own, looking at $1,400 of income from TLT. I really want to cut this position, or at least trim it. I'm waiting, like all of you possible home buyers around the U.S., for the Fed Reserve to cut the rate. Because as they cut rates, this bond should go up. At that point, I will trim down from a $35,000 position maybe to $10,000. Then I will reinvest the rest in a higher yield position to try to get my overall yield of my whole portfolio to 12%. But we don't know what my whole yield is yet, so stick around. Last position is Vici, VICI Properties. Got 25 grand in Vici, 15% of my portfolio. They are a REIT owning gaming, hospitality, and entertainment. Basically, they own the buildings that your favorite casinos are in. They own Caesars. You ever heard of Caesars Palace? Yep, pretty good casino. Even if Caesars is losing money, they still have to pay their rent to Vici. So I don't really care if you go to Vegas and you clean house, because Caesars is still going to pay Vici, and Vici is still going to pay me. So they're about $30 per share at $25,000 in my portfolio divided by $30. You're looking at around 833 shares. The dividend yield is 5.5%. So you get $30 times 5.5 equals $165 per share annual dividend. 833 times 165 is $1,375 that Vici should pay me this year. So let's look at the portfolio dividend overall. I got ADX, I got ARCC, I got BETO, I got MISTI, I got QQQI, SCHD, SPYI, TLT, and Vici. When you add up all of those that I have just under $16,500 in annual dividend income. So looking at the portfolio yield, drumroll please, $16,424 divided by my total position of $163,000, giving me 10.07% on these 9 holdings for my overall portfolio. So there you have it, 10% passive income return on my $163,000. The good news is, outside of that $16,500 in dividends, I am also up about $6,500 in price appreciation since entering these positions. So that's about another 4% per year, which again is about inflation. So if my portfolio can grow 4% per year and I'm getting paid 10% in income, I think I'll be a happy camper. Listen, that's it for this week. Come back each Sunday night for 15-minute money to get your week started off right. We'll see you then.
Thanks for joining me today on 15-Minute Money, the show where I search the financial world for the most up-to-date investment ideas, market trends, and income streams so you don't have to. I'm your host, Nick Bradley. We'll see you next week.